Let's try to go. All right, we are live. What's happening, everyone? Good afternoon. Welcome to the Ask Me Anything Happy Hour presented by the BYOB Money Multiplier team. We're here to answer all your questions around infinite banking and the rest of it. So with that being said, if you're new here, just throw your questions over in the chat and we'll go around the horn, answer those questions the best of our ability, see if we can help guide you along the path. And let's see, we'll do quick introductions in just a moment. All right, and we are live. All right, guys, so welcome to Ask Me Anything. We're here to answer all your questions. Throw them in the chat box. Infinite banking, real estate, HELOCs, one pot system, whatever it is Joe HELOC does. And we'll answer all that stuff for you. So with that said, I'll pass it around so you can do some quick introductions and get to it today. So I'll start out with the leader, the host, the spider whisperer, Brian Fouts.
What's going on, everybody? Spider whisperer. It's too cold for those right now, Steven. That's summertime. We got those going on.
That never gets old.
Yeah. Well, you'll be happy to hear we got some snow this morning, Joe. So there you go.
Good for you. Keep it.
Yeah. About 1 inch, but that's about it. Yeah. So just a little dusting, but yeah, it's starting to get warmer here. Actually, it's kind of crazy. It's been warmer this week than the past couple months. So it's almost summertime, right? Fingers crossed. And we're ready for it. But yeah, with that, I'll pass it over to. I'll skip Steven and go to Kevin.
Everyone knows Steven.
There you go.
Are you really skipping them, or we?
Yeah,
I could go.
He's already gone.
All right. Hey, what's up, guys? Kevin Krause, upstate New York, not far from Shauna, Chris, Joe, and the rest of the team. Excited to answer lots of questions. No spiders going around here, just a lot of rain. And then I do have a new cool sweatshirt we had created. Thank you, Steven. Obviously, check that out there. So looking forward to it. Looks like everybody had a good time over the weekend. But let's pass it down to Tess.
Hi, I'm Tess Hulick. I am a few states away from those guys in Michigan. We've been raining all day today and probably below 50s, so there's not much snow left. Grateful to be here. Last week we were at the think tank in Birmingham, Alabama, with several of the people here, and it was a great time and learned a few things, and we're here to share with you guys today. Over to Joe Kovacevic. I love to say your last name. We love Steven, even if we didn't let him announce himself.
So I'm Joe. I'm the HELOC man and half of the Real Money Masters. You'll be talking to the other half in a second. Up here in Buffalo with Chris and the team, and trying to teach you how to be efficient and utilize your money and velocity with the HELOC and the one pot system. Over to Linus.
Thanks, Joe. Hello, everyone. Linus Nolt here. So yeah, a little further south. I'm here from Hopkinsville, Kentucky. Also had a great time at the Infinite Banking Think Tank last week, connecting with people, learning new things, and just, forging new relationships. I'm happy to be here, answer any questions, and provide more context anywhere I can. I have been practicing IBC for 6 years now, almost 6 years. So it feels like just yesterday, and it also feels like a lifetime ago. So go ahead, Jason.
Thank you, Linus. Thank you, everyone. Excited always to be back here with the audience to ask us anything so we can answer your questions. Sometimes we'll ask you questions too, make you think a little bit more. We like to do that, right, Joe?
Absolutely.
I'm here in Steven's favorite place in all of Florida, the city beautiful Orlando. Excited to always be here with all of you. And now I'm going to go over to my buddy Bree over in Alaska. So Bree, how are you?
Hello, I'm doing great. Hi, guys. I'm up here in Alaska. I'm happy to be with everyone this week. I know it's very intermittent when I make an appearance, but we've got a lot of stuff going on. 2026, I think, is going to be a big year for everybody. I'm coming up on my 4-year anniversary of my first policy. the one that got me out of debt and paycheck to paycheck in those first 8 months. So that did well. And then I've got a year anniversary in already on my HELOC, been very efficient with that. And now it's about creating the passive income cash flow to keep the system running and moving. So I look forward to teaching you guys. Joe and I always say 95% of what we do is education. The other 5% is you implementing what we discuss. So bring up the questions.
Well, looks like we got one question so far. So guys, go ahead and get those into the chat box and we'll get rolling on this first one. Otherwise, you're going to hear us just go back and forth. So Anthony has a question here. It says, how much does the starting age affect cash value in the first few years? If someone starts a whole life policy at age 69, what is the best way to approach it? Good question.
I want to answer.
Go for it.
I mean, you have to remember that insurance is a valuation being done to kind of benefit the insurance company in a sense too. They want to know that you're a stable investment. So the older we get, the harder it is for the underwriters to be like, this person's got their whole life ahead of them. You know, we have two ends there. They're getting close to the end and they're not close to the start. The closer you are to the start, we can do policies as early as 6 months. That's the fountain of youth. So that means you get a lot less dollars in young policies because they get so efficient so fast, and it doesn't take a lot to buy the insurance aspect. But the older we get, the insurance is a lot more. So with the cost of insurance increasing, that's going to have an impact on our cash value. It will really depend on the income situation for that older individual and what they would be able to put in if we're starting to get up there, 60s and 70s.
To answer that question as well, at age 69, it depends on how you're funding the policy, really, because there's more than one way to fund a policy. And so the older we get, there's different ways to fund it when we're older that it can actually get the efficiency going again. When we're young, I mean, you put in $300 a month, it's going to be fine because you got a long time for the compounding. When we're older, just being honest here, we don't have that lifetime ahead of us with that compounding. So oftentimes when we're older, we want to overfund the cash value as much as possible in the early years to get that efficiency moved up and get that compounding earlier on. And so it's just a matter of, is that a fit for you to do that at that age? And so honestly, you'd want to have someone go through your numbers with you and just seeing if it makes sense. Because bottom line is that if you're 69 years old and you want infinite banking to accomplish a specific goal, let's make sure that it does that. If not, look at something different. But as long as it accomplishes your goals, then yeah, go for it. But once again,
and it's definitely worth a call.
Yeah, look at that, Chris Seeger. He knows a thing or two, right? So we talk about quarters of life. That's what Chris's comment is saying is, if you're in the first quarter, right, you're in your 30s, 20s, 30s, or in your second 40s, half times 50s, third quarter 60s. So you're right at the end of your third quarter, and your 70s, 75 is kind of your fourth quarter. If you are making the same amount and you're putting the same amount in, whether you're 21 to 71, your cash value will operate fairly similarly, pretty close. The big difference, like Chris pointed out in the chat, is going to be on your death benefit.
Because it's the cost of insurance.
It's your replacement of time that you can work still.
Yeah, think of it this way. This is the way I always try to explain to somebody. When you're 20 years old, you put in $1 into any kind of life insurance. It doesn't really matter. You're going to get $100 of death benefit. When you're 71 years old, you put in $1, you're going to get $30 of death benefit. So if you want to make those two policies equal, if you're 70 years old, you've got to put in more money for the death benefit to get the same result back out. So it's just called cost of insurance. The older we get, the more that cost goes up. So to make them, very similar, sometimes more has to go in when we're older. Or actually, it does have to go in. More has to go in when we're older to make them efficient. But yeah, it does mainly affect the death benefit. But that death benefit, when it's higher, can take away from your ability to fund the cash value too. But once again, that's kind of getting into the details a bit, but very good question though to think about. Because I'll be honest too, is I have clients that are older and it just doesn't quite make sense because they don't have the way to overfund the cash value early on. And there's just not enough time for the compounding. So it's not always a fit, to be honest.
I was going to bring up if one of the purposes is actually death benefit to be utilized because of his age or her age, then we could still get cash value out of it and still get the death benefit. So I guess it just depends on the numbers and what the purpose is.
Yeah, and Dex has a comment here and follow to the same line here is when you're older in life, sounds like it's better to put more towards the PUA to make the policy work better, buying more insurance. It's not really putting more towards the PUA because it could be the same, ratio. It's just that cost of insurance means you got to put more towards the cost of insurance to get the same result. That's all it really means. There's a reason why when we say what's the minimum to start a policy, not the recommended, by the way, just the minimum. There's a reason why it's 10 times your age per month. If you're 70 years, let's say 60 years old, you can't put in $200 into a policy and make it work. If you're 20 years old, you can put in $200 per month because it's called cost of insurance. That's why. So, but that's something that we can explain in a bit more detail on the one-on-one calls because it is definitely very specific to the individual on how that works. But it is good to know that. And oftentimes that's also why someone says, "Well, Brian, I'm 60 years old. I think I might wait, 5 or 7 years." I'm going to have a comment if you say that because you may be insurable today, but you might not be insurable 5 years down the road. Also, the cost of insurance is going to be more 5 years down the road.
Right.
So, but good questions though. Keep them coming. And Anthony has another question about the same thing. Would cash value funding with a dump-in have less available, such as 70% instead of 85%? So if somebody wanted to go through the dump-in.
No, go ahead.
Go ahead, Liz. Go on. Take it.
No, I would say the opposite. If I'm understanding your question there, doing a dump in to supercharge that cash value in the beginning is going to result in a higher percentage of availability of your initial premium than what it would without a dump in. So no, you'd be more likely to be at the 85% liquidity of your initial premium rather than the 70%.
It's the ratio that the annual to the dump in has to affect. If you run a 2x or a 3x or a 5x or a 6x, that has a huge reaction to the way that the algorithm affects the way the percentages work. By the overfunding of the policy, it gives you more accessible and it increases the efficiency of the policy. So I usually call it the money tree. That's when it's cash on cash available. Depending on, if it's a 9x or a 10x policy, if somebody's dumping in 100,000, backing that up with 12,000 a year, that efficiency rate will get them into that second year or even, third year or second year. And the total efficiency will be around the fifth or sixth year. Yesterday, I did the same policy and I was at 91% in year one because of the ratio of the dump in to the amount that was going through annually. So it just depends on the numbers that we're looking at, depends on your age, everything. If you change one thing, it changes another thing. So we just keep on moving it back and forth that we get that efficiency. We utilize your dollar bills, and that's what that's what makes the policy the policy.
Yeah. And to address the dump-in, so a dump-in, for those of you who don't know, is when you do it in addition to the premium, you do typically a one-time but a large deposit at the beginning of the policy to overfund cash value. Those are technically called a paid-up addition. On average, 90% of a paid-up addition goes to cash value. So Anthony, to answer the question a little bit more, it doesn't matter what age you are, 90% of that PUA is still going to go to cash value. Now, that ratio can be affected by what's called a table rating, but assuming same rating, doesn't matter if you're 50 or 70, same percentage goes to the cash value. The age affects the premium mainly because of cost of insurance. So, and I think that this is what you were responding to here, that your next comment was, I meant compared to a younger person. Yeah, the paid-up addition or the dump is going to be the same no matter what. It's the premium structure and cost of insurance over time is going to be affected by that age. I think that's what he's referring to. All right, go ahead and get some more of those questions in there. David Freswick says, when then is necessary to set this up on a grandchild?
I think it says what then is necessary to set this up. So I'm going to run with that. Like, what is necessary? It depends on what you're trying to do, because for you to fund a policy on your grandchild, so skipping a generation, is typically only going to be a very small policy. So it's not really going to get you somewhere very fast in practicing infinite banking in your financial life with the cash value and the loans, because they're going to have a low limit on what size of policy you can get on your grandchild. In some cases, you can go a little bit bigger if there is a good amount of insurance on that grandchild's parents, so your child or their spouse. One thing I always point out with this question is you want to start from an insurability standpoint. You really want to start with the oldest generation first, which would be yourself, for the simple reason that it is life insurance. There is a death benefit, and that death benefit is a legacy play to pass on to your heirs, your family, when you pass away, income tax free, by the way. And so that's where I like to start, is the older generation first and kind of go down the line that way, just for that death benefit point. But yes, it is also very powerful to set up policies on your children or grandchildren for their future, to be able to start a policy earlier and over time have them get the proper education where you can transfer it to them to take on. And it's kind of a way to jumpstart their banking system.
Yeah. And I think this question here, I think is in relation to the one you're currently addressing. And Fish 54 says, what if you do a dumping also? Well, dumpings are very, very challenging to do on juveniles. So under the age of 18, they're very challenging, just because of the compounding. There's so much life ahead of them at age, 0 to 17. The compounding is going to start getting really, it's kind of ridiculous at the later ages, which is good. But the dumping accelerates it so fast that sometimes you cannot do a dumping on a juvenile. When they turn 18 and get older, then of course you can do those. But yeah, you can do small ones, but they're just not going to be like, you're not doing $100 a month and doing a $5,000 dumping. It's just not going to happen in most cases. But you could do $100 per month, $200 per month, and a $500 to $1,000 dumping. Beyond that, it's typically not an option on juveniles. So they are a bit different of a structure of a policy. And then someone else, where to go here? Someone asked or answered a question. The saving age. You can do what's called save age. So I don't know, Linus, you want to address save age, or anyone else want to address that one as an option?
Sure, it varies by the carrier quite a bit. Some don't allow saving age as far, so it may not be an option for your particular case. But when it is, sometimes it can be a beautiful solution. Other times it's just simply not even a fit. But yeah, what he's saying here is, say the policy is being issued today, but it's able to be backdated 6 months, and say you have it set for an annual premium, you're able to pay the first year's premium and it's dumping now. And then in 6 months, that second year of the policy is starting. So you're able to pay the second year's premium in another 6 months. So in that compressed time frame of about 6 months, you're able to pay both of the first 2 years premium and the dump in if you're doing one. So it's kind of a way to get more premium into a policy faster, but it's not a strategy that's going to be a fit for everyone. So it's definitely a case by case scenario. And there's a lot of scenarios, probably the majority of scenarios, where it doesn't make much difference and is way more hassle than it's worth. So it's certainly something we can talk with you about on a call if any of you have any interest in that.
Yeah, the older you get, the more, the better that is to consider. I guess I would say, because when you go from 55 to 56, it has a bigger impact on your policy death benefit cost, by the way, than when you turn 34 to 35. So the older we get, the more that backdating or saving age should be considered.
I actually did it on my first policy.
Did you?
Yeah.
I did.
From what? From 60 to 60, 59?
90 to 91.
They're not playing nice today.
No, we're not. No. That was what, how many years ago was that now? 5 years ago? 6 years ago?
Mine?
Yeah, your first one?
Going on 6.
6, yeah. Awesome. Okay, so good.
Joe's only 35.
Yeah, there you go. Yeah.
Another reason for backdating sometimes is going to be if a family is setting up multiple policies at once. Mm-hmm. If it's a fit for one of the policies or just the carrier allows it, it can be a great fit to backdate one of them 2 months, 6 months, whatever the carrier allows or whatever's a fit for you, and the other one to be current dated, so that going forward, not all of your policy premiums are coming due at the same time. Instead, you have them kind of staggered throughout the year. That's one of the biggest benefits of potentially doing it, but it kind of only applies if somebody is taking out multiple policies at once. So I've done that. Like I took out 4 kids policies last summer, and I backdated 2 of them by a little bit so that my premiums are a little more staggered throughout the summer rather than all 4 at once. So that's another great point there.
Yeah.
Good point there too.
The last time I tried to backdate with a client, they said you could only backdate by 1 month, and it had to be because of a birth date.
It depends on the carrier.
What carrier? I want to know what carrier that is now.
I thought that was One America.
2 months. Yeah.
2 months?
Up to 2 months, but only if the birth date was in that time period. And so that, yeah,
exactly. So,
Hey, Joe, just so you know, so you're happy. It's snowing really hard right now in my house. It just started. So.
you know what? It's not snowing here, and I'm happy.
There you go. Well, you pass it on.
And almost all my snow is gone now. It's been
The
raining
heat,
all day.
The
And
heat
it's
wave,
51. Yeah.
40 degrees.
Oh, we hit 51.
That's warm. All right, let's get to another question here. So Janelle says, all right, I have debt, but have 12K dump to put in for the first year. So she's referring to a dump in. Hoping to have my debt resolved in 1 year so I can make deposits once a month, 40 now, and wanting to get this going ASAP. So Janelle, I'm not sure there's a question there, but it's a good scenario here. So you have debt and you have 12K to put into a dump for the first year. Now you mentioned you're hoping to have the debt resolved in 1 year so you can make deposits once a month. So are you saying you're going to wait a year to start the policy so you can do the monthly premium deposits?
I think she's trying to do something annually, Brian. Good to ask her a question, get clarity. But I think she's trying to do something annually, clear up all the debt. And then by the second year, now she's ready to make monthly premium deposits to herself.
Yeah.
But some people think that a dump is annual, and it's not.
That's what I was going to say.
Yeah. An annual policy would be paying $1,000 a month, all 12 at the same time. That's paying it annually. A dump means that you're going to take $12,000, put it inside the policy on top of that $1,000 a month. So that's terminology. So you could do it monthly, you could do it annually, or you can dump in $12,000 on top of the monthly or annual.
Yeah. So Janelle, I mean, I'll put the link in the chat box here in just a second. But definitely scheduling a call with one of us to go through your scenario can help you get some ideas of what it could look like. Because keep in mind, you have a lot of clients that say, okay, I want to learn more about this, but I'm not going to be ready for 6 or 12 months. There's nothing wrong with that, by the way. Nothing wrong with that. You got to look at your own situation. Yeah, just also keep in mind that your insurability is not guaranteed down the road. I have personal experience with this, as most of us all do, where being insurable and then uninsurable all of a sudden is kind of a real thing that can happen. But there's ways to lock in insurability, all that kind of stuff. But definitely just recommend hopping on a call and going through your scenario.
And Janelle, I just want to say congratulations because you're of your mindset. You want to pay yourself first before paying that debt. That's awesome, and that's great.
Yeah,
and I love that she said
Janelle.
deposit.
Yeah, Janelle, Janelle, you've been around for a while, so it's kind of the Chinese proverb, when's the best time to plant a tree? Well, it was 20 years ago. When's the second best time? Well, it's today, right? So even if you weren't able to clear all the debt, like we said, starting a policy, starting a convertible term, starting something to get it going, like twice this week already, I've talked to folks. One guy was shocked. He's like, I'm like, yeah, I've talked to you 3 years ago, man. He's like, 3 years? And I'm like, yeah, we started 3 years ago working together, and you've been following up with me for that period of time, and now you're starting, right? So
there you go.
You don't know when you're going to be able to be insured. You don't know when something's going to change. I've had people literally get approved, wait 10 days, not because they weren't planning on moving forward, have a medical incident, not insurable. Just happened 2 weeks ago to me. So
yep.
Linus knows what I'm talking about. He was part of that case. So
no kidding. Yeah. Jason, that's actually something, just like you've done a really good job in reaching out to people that have had the education, had some interest, and just weren't ready or didn't want to move forward at the time. So I know I've helped you with some of your clients from 3 to 4 years ago when you first started, that where you first had contact with them, and then you did so good of a job of providing more education and following up with them. So I'm just saying that because I want to reach out to you here soon and find out how you do that. I don't follow up very well with.
We're doing it right now. We're doing lots of content. You put stuff
Sure.
out there. You keep educating people. You keep serving. You keep answering. You follow up. You check in. And you're not always checking in about. You're checking in about life, right? Like how are you? What's changed? Like the one person just started was because he saw something I had posted about Patty and kind of what we're going through personally. And I was just really grateful for the community. I was really grateful for our thinking. I was really impressed I was able to step up as the leader, like, of the family and be like, I got this. Like, don't worry about the hospital bills. Don't worry about this. And he was going through something with his son where he's in a very serious medical condition. And all the change that's coming, all the things that are happening, like, prompted him to reach out. So I don't know if that's just, consistently sharing, being vulnerable, talking, just whatever you can do to serve someone. Right. So it doesn't always come from just doing education, I guess, is my point. Sometimes it's just sharing your real story and people see like you're going through the same thing and they want to connect with you.
Yeah. In the marketing world, we call that just, it's being in front of somebody. Right. Because you just don't know. And like all of a sudden someone sees your face, like, oh, the light bulb comes on, like, oh, I need to reach out to him. If you hadn't done that video or been, doing that content, they would never have seen your face and would never come into their mind. But yeah.
Exactly. And be proactive, right, Brian? Like send articles to people about like, hey, did you see this? Did you see the SEC chair has 54 policies? Did you see the Ernst Young? Why is Ernst Young and this other financial group saying that people should have 10 to 30% of their assets in whole life? Like, have you thought about that? And then ask a question. Have you thought about that? Like, is that, are you curious about why? And that's for everyone listening too. Like, go look these things up. Like, go look, why did Jim Harbaugh take a contract where it was mostly, whole life or his incentives? Because he knew it was guaranteed. He knew he had control. He knew it was something that wasn't hurting the University of Michigan when he took that contract, right? So win-win.
I always ask this one. The question is, why did the university do it? Because they're going to get paid back more than they gave down the road. So it's a very good financial investment for them, if you want to look at it that way, for the university.
Well, I guess that depends, right? Did they work it out till they get half the death benefit or something? Like, it's probably a huge death benefit with the amount of money that went into it. So does half go to the Harbaugh family? That'd be cool to know. Yeah. Like, there's always
that actually is my understanding.
Yeah.
So what I've actually asked people in the infinite banking space at a different level years ago, that's what they said. Yeah, they come to it. There's a contract. They're an agreement, but yeah, the death benefit can be split, by the way. So his family can get something, the university is going to be recouped plus a bunch more. So it's all negotiation. That's from my understanding. Really interesting how they do that. Yeah.
I'd love to see the details behind that one.
Yes.
Because I looked up a few articles on it, because they, according to the newspaper article I saw, 4 million in 2016 and then 2 million in 2017. According to newspaper articles, yeah. I don't know what went underneath it.
Yeah.
I think he's using it more like a retirement strategy too. I think it was more of a retirement strategy for him. Yeah,
that and like the bonus and stuff too. They could actually, because corporations will pay bonuses via life insurance. People don't know that either.
Yeah.
They pay their bonuses. Hey, here's your bonus. It's tax free. That's a big reason why they do it. It's tax free. And then, of course, the company gets the money back via the death benefit. So it's, anyways.
Well, yeah, I mean, that's incentives like COLI, like corporate and life insurance, like that policy you're talking about, Brian, is more golden handcuffs. Like, hey, I have someone, I'm investing a lot of time and energy in training them and showing them the business and showing them the ropes. I'm going to put this policy on them. It's going to grow in cash value. And then if they leave me after 8 years, I'm going to give them this incentive. Right. It's a way to incentivize people to be loyal and stick around because they don't want to leave if they know they're getting a payout. So, yeah, you can use this. I mean, this kind of went sideways, but this is a fun conversation. Yeah. So I don't even know what question we're answering, but we're good.
Another angle I want to throw out there quickly is the passion that Tess here on the screen has for the workforce, just everyday employee, to learn this and have their policy kind of as a supplemental retirement account without being like a qualified retirement account, because it's a great place for your little bit of retirement a slice of your paycheck basically to go in every month, or for bonuses to land in every year. Because like Tess, she spent what was it, over 30 years in working in insurance companies in the workforce.
35 years inside the four walls of an insurance company. And I keep thinking, what could I have created? So it is a passion, because I think this should be offered to anybody who wants to learn about it, because it's life-changing. Any one of us on this panel knows how life-changing this is. And I feel sad that I worked inside the industry, actually analyzing the financial statements for over 30 years, and I knew nothing about this. And even when I walked out the door, now I was in property and casualty when I left, but even when I walked out the door, people didn't know about it. So that's what we're all here for. And why there's so many lies every week is that we've got to get the word out. It's just that it's not common knowledge. And the more people that we reach, the more lives we can change.
All right, there's another question that came up here. I wanted to just show this comment here real quick. This one, Chris, again, says the dump also usually has load charges. Yeah. So what he's referring to, remember when I said PUA is a dump into PUA and 90% goes to cash value? The load charge is part of that 10%. And the load charge is just the insurance company has to operate and do business. So that's just part of what that means right there. But every company has a load charge that's part of that. Different by every company, but that's why we always just say, generally speaking, 10% goes to cost of insurance doing business, and 90% goes to the cash value. That's why we say that. But good comment there. Let's see here. This is a good one. So Fish says, so would starting a policy on a 37-year-old and then a second one on a 10-year-old work better to maximize the utilization of the policy? Well,
this is, go ahead, Brian.
There's two policies right here. So it's not policy, it's policies now, because now you're doing two policies. Now, we kind of address this, and it's called the waterfall effect, or the top-down approach that Linus also mentioned. We start at the top, the patriarchs, or the main income earner, because it is life insurance at the end of the day, and you want to ensure that potential loss of income. So yeah, we would definitely want to start on the 37-year-old and then look at another policy, then on the next generation, the 10-year-old. And that to me is the way to best maximize infinite banking, is that approach. But what were you going to say, Jason?
I was going to say this. I think this is a common misconception, right? From reading this and seeing the picture, I'm guessing you're not 37. Maybe you are, right? But you're thinking, hey, I'm too old to get started. Like, this is not going to work for me. Maybe you're not insurable or something along those lines. But honestly, if you're the one that's the main income earner, like the one that's providing, the one's protecting and creating for the family, then from every perspective, that it's the strongest to start on you. As long as you're insurable, as long as you can get the policy, it'll work fairly similar whether you're 37, 10, 57, right? We have different carriers for different things that we can go to make it more efficient to work with you. But I always, like Linus was talking about earlier, always look at, how do I protect the main income earner first? Then second, say you had your wife stayed at home, then you're going to protect her up to your level. And then you move on to the kids and you increase your warehouse of wealth over time as you've recaptured more. If you're paying off debt, you've recaptured interest that was leaving you. And now you have need some place to put it. One of the biggest things, a lot of the old timers, people with 30 to 40 years in the industry were saying, and I shared this in a meeting earlier, was when I asked them their biggest regrets, it was like, hey, I didn't sell more convertible term, or I didn't run the term riders out for as long as possible, where people see it in their illustration and they're going to say, why is this cost here? But then when we start actually educating you, well, what happens 15 years down the line if you wanted to put more in a policy, but you can't get a new policy?
Right.
You got to start really thinking long range immediately. And the faster we can shift people to doing that, and the more education we can put around that, the better people will be. So,
and also he says he's 68. So the question about, so I'm assuming 37-year-old is, an adult child and then grandchild. You've also got to look at, does putting a policy on them accomplish my goals? Because sometimes it's generational wealth, sometimes it's not, sometimes it might be something else. And oftentimes someone says, yeah, I want to do it on my adult child and my grandkid. And then I'm like, okay, what are we trying to solve here? They'll tell me, and I'm like, okay, that's not going to be accomplished by doing a policy on that. Or sometimes, yes, it is going to be accomplished by that. So that's why we always say that having a conversation with us is a good first step, because there are so many different ways to make infinite banking work. And this group here, we're very well educated, I guess I would say, on how to make these things work for very unique situations. And that's one of the things where I'm kind of proud of this, of what we do, is because it's very unique. I've seen policies that we've done that some other agents look at and they're saying, how do you build these? We've never seen something like this before. That's just because we're always educating ourselves.
I love how he's actually thinking about it, though, right? We're going to commend him for, like, hey, he's a grandparent. Hey, trying to look into either himself first and then look at maybe his kid and then his grandkids, right? So we definitely got to give him props on that. And then I got to get my little guy to practice. So we'll see you guys.
There you go.
Yeah, have a good practice.
Oh, by the way, bye, Steven.
Oh, yes, Steven's gone too.
He didn't say anything.
He slid out.
Yeah.
He's probably going to baseball practice, right? Probably coaching.
Yeah.
I'm going to do the Irish exit too. I'm just giving you a warning. I don't know when it'll be, but you just look out.
Yeah, I just found out that my 10-year-old has a concussion.
Oh, no.
At school. I got to go pick her up here in a few minutes. That was going to be fun. Dave has a good question here. Could you discuss the benefits or detriments of making monthly premium deposits compared to annual premium deposits to the policies? Good question, because the way I always explain this one, or the answer to this one is, what's your cash flow look like? What does your financial income and just cash flow look like? What's it look like? Because if you have lumpy income, annual might be better. If you have consistent income, paycheck, that kind of stuff, monthly might be good. But you can always change them too, by the way. You can go from monthly to annual to monthly. Usually, sometimes there are a bit of a differences when you do it, but you can change it too. So anybody else want to hit that one up? Because there are some fees and stuff too.
I was going to say, bouncing off of that, look at it just like any other thing out there. There's a lot of subscriptions. We live in the world of apps. You need to download an app just to hook up your toaster nowadays. Everything has a subscription. And generally, when you do annual per payment, they offer a little bit of a discount. It's a little bit sweeter. So we've noticed that there's a few extra dollars more that go towards cost of insurance. So a little bit less towards cash value if we're on the monthly premium scale. I did start my first policy on a monthly, and then I changed it to semi-annual, and then I changed it to annual by the anniversary. Get a feel for it. It's going to depend on, like Brian said, you and your situation. You know best about how your money comes in and goes out. So maximum efficiency is what we look for, and that's why Joe and I love the annual option.
It depends on the way you're getting paid. It depends on how much money do you have in your hand. If you're starting a $12,000 policy and you have $5,000 in the savings account, well, then I would say let's start monthly. And then as you acquired a little bit more, well, then maybe you could go to quarterly or semi-annually and make your way up to that annual amount. I try to get you as efficient and utilize every dollar possible. So it depends on what you have on hand and how the money is coming in.
And to be a contrarian a little bit, right? We talk about efficiencies. We talk about different things. I love like what Lynn just had posted there. Brian, what she said was, we don't have money problems. We have money patterns.
Yeah.
Right. So if that pattern doesn't get corrected, then you should not be doing this. Yeah. If you've got to force savings into this, cool. Now back to the other thing I was going to say. I'm not always looking for max efficiencies. Like, I don't think that is necessarily the approach always. Like, I have policies personally where I've built them so, for my oldest son, where we don't know what he's going to earn, but we built it so we can put X amount in for later. And then like right now, it looks like you'd look at it and be like, that's terrible. Who would design that? Because it's literally $500 a month with $10 of PUA. And that's it. It's basically a whole life with PUAs attached. Or you look at folks that they have different scenarios going on where they're expecting different amounts of money, or they know they're going to recapture a certain amount of money. So rather than having them start a second policy or third policy, you build it to where they can put more into it so they can put it into an efficient policy. That's not going to be as efficient early on, but for the long term, it might work better. So everything Joe said's right. Everything I'm saying is right. It just depends on what you're trying to accomplish. And you're not going to get like a one one approach for every single person you talk to on our team. So because we say efficiencies, money in motion, that there's a certain amount of liquidity and safety that I want too, versus just having everything out in motion, because that can get pretty uncomfortable. Unless you're Joe. Joe's good with being uncomfortable like that. Like I'm not all the time.
Yeah. And one last thing just to put a bow on this one, there are some things to consider that just have to do with numbers. If you're putting a monthly into a premium in, like, say, One America, there's a bank transaction they will show you. The banks charge an ACH transaction fee for every month. It's like anywhere from $4 to like $8. So that comes out. So that does not go into the policy. It's just a fee. That's a bank issue, by the way. It's bank issues. And so that's going to take away from the premium a little bit. Not a huge amount, but it is there. You put an annual premium, that does not happen anymore. So
you're talking about the math, right? From the math, when you do an annual, the money starts compounding immediately. When you put it in monthly, when you put it in monthly, it's going to start compounding when it hits. So depending on, again, cash flow, and Brian said there is more cost. Like you might have costs being $50 a year. If you're doing annual, maybe it's 150 if you do monthly, because you need your person at the insurance company to service the policy. Like somebody has to do the work, make sure it's done correctly, right? So sorry, Brian, I didn't mean to hijack that, but that is basically, whether it's annual, semi-annual, quarterly, or monthly, there's going to be a slightly different cost because how much that is being serviced by the people that are working for you at the insurance company.
Yeah. And then what he's referring to is dividends. Dividends are calculated on the daily balance of the policy that you fund it with. The more you put in up front, the more your dividends you'll get down the road, versus monthly, it's spread out throughout the year. It's not a huge delta, but just ask us to show you the difference. That's the best thing right there. We'll show you annual versus monthly, and then you can make the best decision based upon your situation.
I like that. Yeah, definitely make us just build more policies. That's okay. Joe loves doing the policy.
Yep. All right. And Anthony has one. Dump-in is not the same thing exactly as a paid-up addition, correct? No, a dump-in actually is a paid-up addition. It's 100% a PUA. But there's 3 paid-up additions in most policies: inside the premium, the dump-in, and the dividend. So the dividend and the dump-in are pure PUAs. The premium has a PUA built inside of it, but we'll show that to you on your illustration.
These are Frankenstein policies, guys. We piece and bob the things together that make them magic and awesome. So
yeah, I had an old timer yell at me and say, "It's not a dump-in. That's not a real thing." And I was like, "Yeah, he's right. It's a single premium."
Lower level, yep.
Well, it's funny. I mean, where's the term dump-in come from? The insurance companies, by the way. So
does it really?
Yeah. There's one of the insurance companies calls it that. I can't remember which one, but you'll see it somewhere. They'll call it that. Or they call it a lump sum.
They didn't used to. We influenced them to call it that.
Let's move away from it. Let's break the trend. Let's go back to a single premium. So we're not, because people get confused. They're like, I'm doing annual, but I'm dumping in this much money. I'm like, are you doing an annual premium deposit plus a dump in? Oh, I'm dumping in that. What are you doing in year 2? Like, it's literally a weekly conversation. It's like,
I really think it's because when we're talking about our money and putting it into the policy, we're saying things like, I want to dump it in there. I want to shove it in there. I want to get all my money in that policy. So we never care. We're just like, we just need to shove money into the policy. But yes, the components and pieces, this is why looking at your illustration is important. A lot of the portals, you can see a breakdown too, but yeah, there's a lot of pieces, lots of PUA.
All right. Juanita has a question here, I think. HELOC question: income 3,000 and change, cash on hand 30K, and 130. So
we need more.
Not sure what the question is. We would need quite a bit more information, and mainly understanding what you're trying to accomplish to see if a HELOC is trying to accomplish that. If you owe 130 on a home, assuming you have equity, you can get a second lien HELOC or a first lien. But once again, it depends on what you're trying to accomplish, if a HELOC makes sense and if you can even qualify. But definitely reach out to our team, grab a call, talk to Joe or Bree if you want to talk more about the HELOC side of it. But yeah, and this kind of falls into this question here from Charles. It says, how do you obtain a HELOC to purchase a home, or is this a good idea? So I'll let Joe and Bree take the first part. The second question is it a good idea? That depends on if it has to make sense to you, and the math has to make sense for it to be a good idea.
It's all about the numbers, Brian. It's all about the numbers.
Yeah, it can make sense to Joe, to me, and to Bree, and to Jason. Everybody has to make sense to you, though. And so
What
our
is a
job
Go
is
ahead, Bree.
right? What is a HELOC? That's key. It's a home equity line of credit. What is a mortgage? It is a loan, an amortized loan. So you're going to be paying a lot more interest out the butt with a mortgage in the beginning because it's a loan. If you were going to buy a house and you needed a bank product, would you rather get a one-time sum of money that goes to the purchase of a home that you're paying a lot more in interest for over 30, and now they're talking about 50 years? Or would you rather get a revolving line of credit that is simple interest and you only pay on what you use and you can refill your pot and utilize again? You can use both. You can use a HELOC. Even if it's your first time purchasing a home, you can obtain a HELOC to buy that home.
And there's
It's
different.
just about the numbers, right? All about the math. It has to make sense.
So there's also different things with a HELOC that you can get that you cannot get with a mortgage. So depending on your credit score, depending on your income, you can absolutely go up to 89% with a HELOC. Well, when you buy a mortgage, it's 80%. You have to put 20% down or you're going to pay PMI. So if you put 11% down on a HELOC, there's no PMI. And it's a revolving line of credit, like Bree said. So there's different options either way. However, amortization compared to simple interest, that's devil's arithmetic. Amortization is the worst thing out there, and that's what makes the banks all their money.
Mm-hmm.
All right. J10. Right?
1
All
year.
right. Yeah. So how long does the medical last from date of first issue of policy? So it's the medical lasts 12 months from not the date of issue of the policy, but from the medical when it was done. Keep that in mind. Not the policy date, medical date. And by the way, it's not a guarantee that it'll last 12 months. It's up to the underwriter as to if they'll allow it to do it. 6 months, usually it's almost 100% yes. 6 to 12 months, it depends. So I've had clients that say, "Oh yeah, let's do it again," and no, they had to redo it because of some things they saw. But it just depends.
Yeah, it can be. Yeah, if you go back to the doctor, it'll probably have you redo it. If you are like if your cumulative amount of premium goes up to a certain amount, it's gonna like I did 2 my first year on myself, and it was within 6 months, 7 months. And the first one I didn't need a paramedical because it was less than 2 million. Second one didn't matter what I was going to do because I was over 2 million. So then I had to go and do additional things and submit additional things and do a full, blood, height, weight, blood, and urine. So
yep.
I had the same thing.
There's sometimes other requirements too if you're trying to get an additional policy or add more death benefit, because even if, say, your previous medical is going to be fine, maybe there's something new like an EKG that you still need to have somebody come out to your house to do that. So anytime you're doing additional policies or whatever, there's always something they need. It just depends on how much trouble it might be to you. Yep,
100%. All right, Janelle said, yeah, she said, thanks. It's a bit confusing, even though I've been listening for a while. I mean, yeah, that's the whole purpose of this is the journey. I mean, if you stop learning, then you stop moving forward, as I always say. So always be learning. That's why in this comment box, we've got so many people that have policies that are still here learning because they're learning. Also, I'll just be honest, we're also always learning. Even though we do this every single day, we always learn. We have people at the Nelson Nash Institute here recently learning there. So yeah, and that's why we're also passing that knowledge on to you. But yeah, definitely hop on a call with one of us to see what your situation is and go from there. All right, Tyler says, is it possible to up your annual premium on a policy after having it for a few years? Simple answer, no. Can you potentially put in more? Maybe, but not guaranteed. But typically we just tend to say no, that's not an option, even though you might be able to put in more, but that's why people do the second policies. So anybody else have any comments on that one?
It depends a lot on the policy design. Most carriers do have ability for more if it was designed for it. Easy way to find out is to call the carrier your policy is with, call the policy service line, or work with your implementation specialist that is available to you as part of our team, and they can find out for you.
Mm-hmm. Exactly. Did we just lose somebody? Oh, Bree. Oh, she's out of there. Good question though. This is another one. The Sassy Trainer says, going into a cash pay clinic for cancer. Thoughts are with you on that one. Thinking to use card and then pay off with policy to get points, then lower payback rate. Then a lower payback rate.
I like that.
Yeah, I like that. Yeah, that could work. Yeah, that could work. I mean, if you have I'm not sure if you have an existing policy or not. Use the card to pay. Yeah, get the points. I mean, I have people that do that. So there's one of the strategies is to have a credit card, which I'm trying to do this right now, by the way, that you put everything you can on the credit card, and then you pay it off with a policy or whatever, just running as much as you can through the credit card to get the points. I had a client that was getting like an additional. They had a 10% raise in their income per year just by doing that on 2 cards. Yeah, so they had additional 10,000. I think it was 10 or 12,000 per year of income just by doing that. It's pretty cool.
I put everything on the credit card. I have never paid an interest payment. I have 968,000 points right now. As soon as I hit 1 million, I'm going to hit the cash button, and then they're going to deposit $10,000 into my checking account.
Yep. I had a one for
company pays me to use it. It's an asset.
Joe, that's a huge waste of points. Do you know that 10,000 could buy you that $10,000 in cash of worth of points could probably buy you $50,000 worth of hotels and flights and things like that if you knew how to do it. There's some really cool strategies out there. I'm not the expert, but I have seen them.
I think it's more fun seeing $1 million.
Sure. Yeah.
I used to use one of my cards from a business I used to have that was, like a 7-figure business, run a lot through the cards. I'd use that for Christmas. So all of our Christmas stuff was covered through a business credit card and points. So yeah, I kind of wish I had that now for kids.
And that's what we teach people how to do with the one-pot system. Everything goes on credit card, and then everything goes into the HELOC, and then once a month you pay your credit card. That's doing velocity banking.
All right, so Lynn Green, another question here says, trying like crazy to get my son-in-law, all right, good luck with that one, to start a policy. My daughter has one, and neither of us have been able to make him see the light. He's watched the 90-minute video, and I sat with him. I mean, there are some individuals where you're not going to be able to change the mindset, just to be honest. It's just not there. But what I've always said is the best way to I don't want to say influence them, but is to live the life that they want to live by doing this concept. So if they see the physical results of you doing this and they're like saying, oh, I want to do that. You're like, oh, this is what it is. It's like that thing with kids. Kids don't want to do the work, but they want the result. So show them the result. All of a sudden the work becomes like a secondary thought. I do that with my kids all the time. They want that nice thing, but but they don't want to do the work without seeing the nice thing. So literally buy the thing, put it in a cage over here so they can see it. Then go do the work and then open the cage up, and then it's weird how that works. But yeah, that mindset thing, it can be a tough one to crack, just to be honest.
Lynette, we do this all the time with if there's a spouse that is into it and the other one isn't. We stay on the call and we answer questions, and I give them different analogies. We do activities that I ask him to be a part of, and then it opens up his mind, and it kind of changes the way that they're looking at things. So that's one of the things that we do on our calls.
And we changed, we put on our website, we have interactive diagrams now, and it breaks down the systems and strategies in a different, to the nuts and bolts, to the most basic level of understanding, comparing to what you already use and know, HELOC to a traditional mortgage, and the IBC policy to using a traditional bank account, and then there's velocity banking, comparing using either system for velocity banking. So definitely just keep at it. But like Brian said, it's best to be putting your mask on first before helping others, and they'll see the light eventually. It's taken years, but my mom's finally on board because she's been seeing it all, and those diagrams put through the last little push she needed.
The diagrams on our website are interactive, so it's like an Atari game. So when you click on the coins, you can see the flow of money. That's on realmoneymasters.com. So that might help them a little bit too, because it's interactive.
And Lynn has been around for a long time. I think she goes back about 5 or 6 years. So maybe getting on a call, maybe it'll work this time.
It is time.
Yeah. She's been around for a while.
All right, let's go. We're going to do some rapid fire questions. We got a few minutes left. All right. So Timothy, One America policy recently got with us, have also mass mutual policies with one being a convertible term. Can you design new policy for me, or am I restricted to working with an agent? No, we can do that for you. So yes, just reach out to us, call us. Yeah, we can definitely do new stuff for you. You do not have to work with an existing agent. Yeah, no worries there. Zelda says, whole life insurance. Once you get married, would I have to change my policy? No. Or is it just individually? Yes, it's just individually. Many questions. What's the max I can put in yearly? It depends on the policy design, depends on you, depends on how it's designed at the very front. We would need to know more information to give you that answer. So I'm going to put the link here in just a second to schedule a call. Go ahead and do that, and then we can obviously help you with that. Good question, though. I think I already answered that question.
Yes.
Yeah. Okay. Oh, he put it in twice. That's why. Craig says, knowing that I during insuring a 60-year-old is more expensive than a 57-year-old, and you plan on having multiple policies, should you buy a second one before maximizing the first?
No.
Not always. No, you don't have to maximize the first, because I mean, if you're funding your existing policy, you're maximizing right there. So maximizing it just means putting in the premium that you're scheduled to put in and putting the dump in that you're scheduled to put in. That's all that means. Maximizing it is just funding it as designed. As far as the second policy goes, it just depends on when it makes sense to you to do that second policy. Obviously, if you're insuring a 60-year-old, we know that when we hit 61, our amount of maximum death benefit goes down. It goes from 15 times your gross revenue to 10 times your gross revenue. So your total death benefit goes down at age 61. So just keep that in mind. It's by the way, it's 41, 51, 61, 71. Every time you hit that age, it goes down by a certain amount. So
I need to say something too. Yeah. If you're 57 and we maximize that death benefit out to the IRS stipulations, you probably wouldn't be able to even get another policy in 3 years. So you have to understand, it's not just, everybody gets $100 million of death benefit. It goes by your income. It goes by your age, your assets. So, I mean, there's only so much death benefit. I mean, I couldn't get a policy for 3 years because I maximized mine out 6 years ago. So, you have to bring that into consideration too, because there's limits and limitations that you can get. So.
Yeah, we all have it's a weird thing to think about. We all have a life value assigned to us. It's based upon age and gross revenue, not net income, gross revenue that we, that's all sources of income combined. But just keep that in mind. And that's different for everybody. So, and that can change over time, of course, up and down, all that kind of stuff. But that's how we can go through with you on the call. So yeah, as Lynn says, she has 3 policies and then her daughter has 1. So that's awesome. Congrats on that one.
For Craig Parsons, help him understand, Lynn.
What was that?
Sorry, I was answering the last one with Lynn talking about the 3 policies. I would definitely try out the diagrams and see if a different learning style might help him understand.
Yeah. Depends on. I mean, here's the thing. It has to accomplish something for him. That's the thing for most people. If they can't see it's going to help them accomplish something that they want, then they're not going to look at it. But if they can see a clear path to that goal being accomplished, then their mind will open up. That's really what it is. And that's why kids are so easy, because they want a lot of things.
Bree, did you put the website in for Lynette to look at?
I'm not in the chat. Let me join.
All right. Well, I think we got through all the questions and on time pretty much this time too, which is awesome. All right. Well, with that, I think we got through everything. Bria, I'll let you put that in there and then we'll call it good. But I want to say I appreciate all the questions. Definitely, guys, keep coming here. Keep coming to these events. We do 6 live events a week, live stream. We have our Monday. We have Tuesday webinars. We have 3 events here on Wednesdays. We've got our WTF in the mornings. We got Wealth Wednesday webinar. We've got the Ask Me Anything here. We've got Craig and Marius are doing the Thursday calls now on the vaults. Is that a 7th one? I think it is. Then we've got the other one, like the PMC event on Thursday, I think it is, or Friday. We got a lot of things going on. So the more you're around all of this, the camper, as we call it, the more information you're going to get. And the more knowledge you have, the more you can do in life. So I just recommend just stick around, ask these questions. Very good. So with that, I'm going to put up Lynn's question here real quick. So her son-in-law sold the house, not planning to buy for a while. I like that idea, by the way. I thought it'd be better to save into infinite banking. Potentially, it can be potentially. Just got to keep in mind, premium, dump in size, all that kind of stuff. But that could be a good opportunity for them. But with that, everybody, appreciate you all being here. Appreciate everybody asking the questions. And with that, we will see you next week. Take care.
Bye-bye.